So in this video, I'm going to consider this whole idea of patterns of trade, and the patterns of trade really consider what is known as the value of trade between countries and major broad areas in the world economy. So, for example, how much trade is going on between the north and the south, between developed and developing, even between continents. And you can also look at this in terms of export destination, i.e., in a particular country, where are exports going to? Why are we exporting to, say, Europe and not to Australia, for example? And what is happening to the changes in those as well over time? So this is a really good chart to start to consider, and we'll look at this in a bit more detail later, where we have what we call the intra and the extra regional trade. Intra-regional trade is simply the trade between and within a geographical boundary, so maybe in Africa, between all the African countries. Extra intra-regional trade is trade outside of that region. So take Africa, for example, we see that something like 16% of their trade is within the African continent themselves. So countries within Africa trading with another country in Africa. And the vast majority of their trade is done outside of Africa. Whereas if you take Europe here, you can see hopefully that we do 60%. 60% is about here, look, 70% of trade is within the European Union. And you can guess why, I hope, if you know about the customs union in the European Union. So what we need to look at is the overall causes. What is it that's behind those patterns of trade, and also what's maybe changing them as well. So there's basically four things that we need to consider, and the first is the comparative advantage that each country or each continent has, and we're going to look at their factor endowments. We're going to look at capital and labour intensive industries and where the new iPhone 14 is being produced. We need to look at emerging economies. These are smaller economies that have been growing rapidly as globalization has occurred, and they're taking a greater share of the world markets. And in particular, we're going to look at an issue within those countries of what we call income elasticity and the Prabish Singer problem. Okay. We need to look at trading blocks and bilateral. Bilateral simply means between two countries, but trading blocks is between more than those countries. So it could be, the 17 countries in a trading block. And basically, a trading block has lower tariffs, and so if you have lower tariffs, then you're going to trade more within that block. And lastly, we're going to look at exchange rates as a possible reason for these patterns of trade, and we're going to look at lower exchange rates, higher exports, or even a problem known as the Dutch disease. So those are the four major causes, but as we go through them, I really want to stress that the key thing is that whenever you say something is happening, let's say comparative advantage is changing, you move your analysis through to, and that affects the pattern of trade. That affects the volume of trade that we're doing with those particular areas or other countries, as it were. Okay. All right, so let's look at comparative advantage. And basically, if you remember that one of the underlying assumptions of comparative advantage is that it does depend on the different factors that they possess. So if you've got a lot of labour, we'll see here, large supply of labour, you're going to have lower wages, and so you're going to have a comparative advantage in labour intensive, possibly therefore lower priced manufacturing goods. But over time, what happens, and this is the change in the comparative advantage, as you export those goods, obviously your industry starts to grow, the demand for labour, which is a derived demand, remember, starts to grow, and therefore wages start to increase for your workers. So countries that start off with an advantage of having low wages start to lose that advantage over time. In addition to that, you could bring in the law of diminishing returns, which means basically that as a industry grows, then what's going to happen is their marginal and finally their average product starts to fall. So putting those two together, the wages rising and the productivity falling, you're going to find that the unit wage, the cost of producing one good, starts to rise, and therefore they lose their comparative advantage. They need to raise prices for their exports. Demand for those exports will slow, and so it will shift away from those low-price manufacturing goods. And it may be that there's other countries that have come along with another large supply of labour, and they're taking their market. So a good example to bring some application into this is China. It grew on the basis of a low-cost, labour-intensive production. I don't think most of China now possibly is in that sort of production. They do have some in low-wage jobs, but the demand for those Chinese workers have grown, and so therefore their wages have been rising. And their productivity has been slowing down. So much so that Apple have now announced with the iPhone 14 that they are switching some of the production to India, and they say concerned at these rising costs. I'll give you a few examples in a minute. But also, there's other factors at play. It's not just about labour costs in China starting to grow compared to, say, India, but there's other factors, political concerns, and possibly the idea that more and more people might put tariffs on Chinese-produced goods. So this is the evaluation that, although comparative advantage would explain it, there may be other factors at play. So let's have a look. This is from the FT recently, and it's saying that Foxconn, Pegatron, all expanding production in India, given the rising labour costs and the ongoing trend of diversifying. We're seeing a growing pattern, proportion, I think starting at 5% of iPhones being built in India. So this has been going on for some time, that China has found that it's started to develop with low cost, low wages, but increasingly what they've had to do is they are moving some of their production overseas into other areas where the costs are even lower. TechCrunch came up with this, that Apple are going to move, as I say, 5% of iPhone 14 production to India, and then start to expand its manufacturing capacity, producing 25% of iPhones by 2025. Vietnam is going to contribute 20% of all iPad and Apple Watches, 5% of MacBooks, 65% of AirPods. Really good application here to say that China is losing its comparative advantage maybe, and that is why the pattern of trade, where are we buying our iPhones from, is going to change. And one of the key things is that India has attracted, it says here, the investments by offering subsidies. If you Google this, it's a really important thing that India are trying to go rapidly through subsidizing industry as it comes in, and coupled, it says, with ample labour resources, huge supply of labour and competitive labour costs. So not necessarily the only reason the wages going up, but certainly it's another reason why Apple has switched to India for some of their production. Okay. Worth looking at two countries here. I'm going to look at Cambodia. It says here in this article, Infinity Solutions, I've given you the link if you want to look at it, why Cambodia is attractive to business. 9 reasons. But it grew in ready-made garments due to the amount of labour and the low cost of labour, it says. But what's important, I think, is that this is the 6th reason. There's 9 reasons. Competitive labour market, if you look at that article, is the 6th reason for that. So there's other reasons as well why Cambodia is attractive to businesses. You can look at Bangladesh, an amazing country to consider, again, in terms of their ready-made garments industry. So both these countries have ready-made garments. Bangladesh, 84% of their exports are coming from garment exports, and the salary structure is the major reason, it says. They have a minimum wage $97, China $162, $358. So these are changes, as I say, in the comparative advantage, which has enabled the pattern of trade to switch so that more ready-made garments are being made in Bangladesh, and so their exports are growing and growing in that particular industry, and our imports in Europe, US, many other countries, a lot of our garments are made in Bangladesh. So get through to an analysis to nail it and talk about how it affects the pattern of trade. Just a final one. These are the manufacturing labour costs for China, Vietnam, Mexico, and how they've changed. So in China, nearly $5 per hour for manufacturing costs, now risen 2020 to $6.50. So that's $1.50, and you might think, well, that's not much, but this is per hour. In Mexico, $3.82 to $4.82. So you can see the change in the manufacturing costs, the labour costs. Bearing in mind, if you're an American, you might be wanting to bring your goods in from Mexico. Again, much cheaper to bring it in from Mexico. So that's not just the labour cost, but there's the transport cost. So these are some practical examples that you can use for application in the whole area of a change in the comparative advantage. Countries will lose their advantage in certain goods, so the pattern of trade will change. Okay, second point, emerging economies. So remember, an emerging economy is a very low income, less developed, pre-industrial. These are countries which are really reliant a lot on agricultural output, etc. And so, the idea is that these have been emerging with globalization. It has allowed these countries to start to emerge and start to transition from these low income, less developed towards a modern industrialized. And you can see it here. This is emerging markets data, and it goes up to about 2021. But, their growth has been massive. This is the GDP per person. And these emerging markets have been growing a lot faster than, say, the US. Now, funnily enough, COVID has actually caused a bit of a problem here, and there's possibly a switch going on. But the analysis, as they emerge, they transition, they will take a greater share of world export values. So their exports are going to be growing faster than other countries, so that that's going to change the pattern of trade. Emerging economies taking a greater share, and the workers in these countries then, as they emerge, can start to afford more goods. That leads to more imports too. So again, patterns of trade will change. Okay. One of the problems with these emerging economies, and it's something to introduce now, possibly you can use this in your work on patterns of trade, is that there's a problem called the Prabish-Singer issue. And that is that commodities as a general group of products tend to have a low income elasticity of demand. So as world income is rising, the demand for commodities will rise, but it's going to rise by a smaller amount than, say, manufactured goods. So manufacturers have a high income elasticity of demand. So the demand curve for manufacturers over time is going to shift out more than the demand curve for commodities, which means that the price of manufacturers is going to go up faster than the price of commodities. So what happens is, as this world income rises, demand for all products rise, but the emerging economies are often based on these commodities, and they have a low income elasticity. So the revenue that they're getting is going to slow down. It's going to rise, but at a slower rate than these large increases for manufactured goods. So therefore, the suggestion is they're going to decline as a percentage of the world exports. So they're still going to rise, but as a percentage, they're not going to rise as much. And so that as a percentage, they're going to get smaller, which is good evaluation, if you like, of emerging economies getting greater market share. This is suggesting that emerging economies, because of this problem, might not, and the percentage share of world exports for developed countries, those who have gone through the emerging phase, they might start to export manufactured goods, and so their world percentage market is going to rise. So hopefully that's a good evaluation of emerging economies for you. Some application, let's give you some ideas. Vietnam, a fascinating country to research, particularly after the war with America. How is it that they've become such a vibrant, strong economy? Well, worth researching that. But between 2010 and 2019, their share of world exports grew from 0.47 to 1.5%. Services grew. Thailand doubled their share of world services. The UAE multiplied by 4 times. Bangladesh doubled share of not only services but goods exports. Okay, so interesting economies to bring into your application as to say these economies as they have. This is an example of economies that have been emerging and growing, and therefore the pattern of trade has been changing. Good sort of soundbite, if you like, is that Vietnam between 2010 and 2019 doubled their share of goods exports, tripled their share of service exports. So again, some good information, good application, I hope, that you can take away with you for emerging economies and how that's affected the pattern of trade. Okay, third one, a bit easier this one, trading blocks. We all know, hopefully, what a trading block does. It reduces the tariffs within the trading block to other members of the trading block. It puts a common tariff against other countries outside the trading block, but it has a reduced or no tariff within the trading block. Therefore, the relative price of trading with members of the trading block is going to be lower. And it's useful to talk about relative prices, okay? And you'll see later that trade is created. Trade gets created within the trading block. That's called trade creation, okay? It'll be diverted from countries outside the trading block. Good explanation, therefore, of why the patterns of trade have changed, and you can use that European Union example, okay? So the demand for exports from members of the trading bloc will increase, therefore altering the pattern of trade. More exports within the trading bloc. Got to get through to that pattern of trade, if that makes sense to you, okay? Give you an idea, this we've talked before. This is Africa at the moment, trading about 15% between themselves, but they've just started an African continental free trade area. This comes from the World Economic Forum, and it says that 18% of trade will go up to 50%. So this number here, could rise up here. Brilliant example in that quote of reasons why trading blocks will cause a change in the pattern of trade. 60% of Asia's trade, they're in the ASEAN trading bloc. 60% of their trade is intra-regional. And as that grows, maybe we're going to have a world which is, we talked before about globalization, maybe we're going to have a world where the globalization is slowing down and there'll be more global trading blocks. Okay, so useful information, I hope, for trading blocks. And lastly, relative exchange rates. Well, by now, I hope you know if there's a fall in the exchange rate, price of exports are lower, price of imports are higher, raising the amount of exports. Your export prices can come down, therefore you're going to sell more of those exports. You're going to bring in more imports because the price of imports is higher, so you're going to cut the amount of imports, and it raises the amount of exports and reduces the amount of imports. So the pattern of trade in your country is going to shift, particularly with the countries where you have had a fall in the exchange rate against their currency compared to others, remember. Okay, so again, get through to the pattern of trade will shift. You can reduce imports and raise exports to these countries where you have a lower exchange rate. But let's finish off with a bit of understanding of what is called the Dutch disease. Now, the Dutch disease is very straightforward, really. It's the fact that when countries like Holland and the UK discovered oil in the North Sea, a lot of countries poured investment into the UK and into Holland, causing their exchange rate to rise. Now, that was okay for the oil sector because they've got this big supply of oil and they were exporting it and finding it quite easy to export this newfound source of wealth. But what about the other sort of manufacturing side of the economy? The manufacturers found it really difficult to then to sell their exports because of the high exchange rate. And so therefore the manufacturing sector declined. So it's a shift of the pattern of trade. But everyone will bring up in the exam the Dutch disease. This is more recent. 2014, Canada, they found a big oil sand. They found a lot of oil in their sands, and it says it led to an overvalued currency and decreased competitiveness. Similar has happened to the Russian ruble. But then when the price of oil dropped, it has eased the concerns for those countries. So the UK is a good example here where, but you can use Canada, but you can use Holland. But the UK used to be a strong manufacturing base. Possibly some say with that rise in the exchange rate from the following of the North Sea oil, that has caused the manufacturing sector to decline at the same time, I would say, as lots of other countries came through and could manufacture at lower costs than the UK could. So again, it's not a simple picture. This comes from the Economist. Some economists protest the Dutch disease is no bad thing. They should focus on what they're efficient at producing, comparative advantage. But commodity prices fluctuate and they need backup industries. This is so important. We'll look at this in development economics, that if you get the benefit of high oil prices, you shouldn't just squander those. You should, as a country, develop other industries within the country. But commodity-rich countries tend to struggle. One paper showed 97 developing countries who've got this high ratio of natural resources, oils, commodities, to GDP, had low growth rates during the 70s and 80s. And so really, when the commodities run out, there's little left to sustain the economy. So hopefully that gives you a good idea of what happens when the exchange rate changes to the pattern of trade, and a little bit about the Dutch disease, which we'll come back to. So overall, these are the four essays. Tend to be of the nature where they say, comparative advantage is the major reason for the change in the patterns. You have to say why that is and why you agree with it, bring in some application. And then you would say, but it's not the only one. There's this one, or this one. And to be honest, trading blocks is the easiest, I think, to actually use if you want to do some pretty decent analysis. So hopefully that gives you a good overview of the causes of the pattern of trade.